The dollar milkshake theory. This is important to learn as we are moving towards some things happening. The dollar milkshake theory. This is something that we should understand really well as we see the money printers around the world start to print up. What will the consequences of that be? How will it affect fiat currencies? How will it affect Bitcoin? My name is Forrest Hodel. I'm a Bitcoin educator and Bitcoin coach. And if you need help with some security needs, anything Bitcoin related, you can book me for a one-on-one session in the link in the description. So this here is a tweet thread by Peruvian Bull about the dollar milkshake theory. I'm going to read out this thread. It's quite expansive. It gets into all sorts of details, and I'm going to expand on it even more as we go. So he starts off saying the milkshake reloads. The dollar index has crashed to its lowest level since April 2022, and bears are celebrating the oncoming collapse of the greenback. Little do they know this only makes the system stronger and changes the nature of the endgame. He says this month, amid chaotic trade policy moves and volatile global markets, the DXY dollar index has weakened considerably. The drop is mostly being driven by ongoing trade tensions with China, where both countries have imposed heavy tariffs on each other. Since the beginning of 2025, the DXY has fallen about 8.3%, and this latest dip below the 100 mark is the steepest slide we've seen in years. Right now, the dollar is clearly under pressure, and people are watching closely to see what happens next. Peruvian Bull continues here. Dollar bears on X Twitter have been celebrating this move, decreeing the coming of the dollar system and rise of gold as a new global reserve currency. Ironically, this will likely play out eventually, just not the way they think. Peter Schiff, for example, on Kitco News last week proclaimed, well, I mean, this is something that I've been predicting for quite some time now. It was inevitable. I always thought it would be an external dollar crisis that would set these events in motion. I didn't realize that we would do it to ourselves, but we have. We've pricked our own bubble, and there's a lot of air that's going to come out of it. You know, Donald Trump looked at our huge trade deficits and just concluded that the trade deficits themselves were the problem, and then they must be the result of foreigners cheating us and ripping us off. Let's briefly review the dollar milkshake theory by Brent Johnson. Since the almighty greenback is the global reserve currency, it is widely for a variety of purposes, including settlement of trade, invoicing, bills, etc. are settled in dollars. Foreign exchange reserves for central banks are held in dollars. Bank of Japan using and holding US treasuries to prop up the dying yen. Lending for international debt and loans, so IMF, World Bank, and other lend to sovereigns in dollars. Foreign currency exchange, most currency pairs are quoted against the dollar, so the dollar is the denominator in that case. Outright dollarization, some countries use the US dollar as their official currency, such as Ecuador, El Salvador, or alongside their local currency. Remittances or cross-border transfers, dollars are widely used for sending money across borders. It's used as a safe haven asset. During crises, investors buy dollars for safety, causing global capital flows into US assets like treasuries. And the euro dollar market, perhaps most important of all, US dollars denominate SWIFT transactions, international bank reserves, and offshore banking systems. The offshore system is called the euro dollar market. US dollars are lent into existence by foreign banks and used to finance global commerce. Banks in Pakistan lending euro dollars to oil refineries in Iran for trade, for example. All of this creates persistent and ubiquitous demand for USDT or USD, US dollars. It turns out that the demand might be met with supply, or the global monetary system begins grinding to a halt. This is what Belgian economist Robert Triffin warned Congress about 65 years ago. So this has a little summary. Let's get into it real quick. Triffin's dilemma. Testifying before the U.S. Congress in 1960, economist Robert Triffin exposed a fundamental problem in the international monetary system. If the United States stopped running balance of payment deficits, the international community would lose its largest source of additions to its reserves. The resulting shortage of liquidity could pull the world economy into a contractionary spiral, leading to instability. If U.S. deficits continued, a steady stream of dollars would continue to fuel world economic growth. However, excess US dollar deficits, so dollar glut, would erode confidence in the value of the US dollar without confidence in the dollar, it would no longer be accepted as the world's reserve currency. The fixed exchange rate system could break down, leading to instability. So they're stuck between a rock and a hard place with the Triffin's dilemma. Many attribute the blowout of the trade deficit to currency manipulation by third world countries, unfair trade practices, or exploitative labor practices, all of which are true and definitely contribute to the deficit, but they don't explain the whole picture. In fact, as the global monetary system becomes more and more unmoored to the fundamentals of hard money, it increasingly relies on liquidity, which in essence means dollar liquidity because the global economy runs on dollars. It's the most important currency in the world. Therefore, the offshoring of the US industrial base, in brackets, as much manufacturing output loss as a major war, was not only done to juice US corporate profits, but it was done as a byproduct of the necessity to export dollars to the world. The world needed dollars. The US was happy to give them to them and create these deficits that now Trump is trying to rectify with tariffs. So US goods and services trade balance, and we could see it's just gone down considerably and rather quickly over the last few decades. In short, this means if the US wants to keep the monetary system humming, it needs to keep a trade imbalance and grow that imbalance over time if the world continues to grow faster than we do. Obviously, as you see above, this trend has been accelerating as the third world, especially Asia, joined the Eurodollar market in the earnest in the 1990s and 2000s. So you can see this right here, NAFTA, and we can see a little bit of sideways and then down like crazy after the North American Free Trade Agreement happened. And then China joins WTO, and we can see massive spike of deficit downwards. So we continue here. In any case, the outflow of dollars feeds the Eurodollar market and also provides a way for the dollars to be invested back into the US, as these dollars are searching for yield, and the easiest place to invest dollars is in a dollar denominated instrument. So this is treasury bills, US equities, and real estate, and so on. This is called dollar recycling, and as I've touched on the effects this has on the US economy in depth in my Dollar Endgame book, here's a graphic that shows just the process. Let's start right here and move along here. So we say, so in gray here, so the Liberian economy grows, and with it, the size of this financial system. Your central bank needs to hold more foreign exchange reserves to defend currency / lend to its banks in case of crisis. Your central bank prints LD, so that's not Larry David, that's Liberian dollar, to buy USD in the form of treasuries, which goes over to here to the end result, which is Liberia gets hyperinflation, US gets consumer goods and valuable commodities. However, it also goes towards this, which is this bids up treasury prices, effectively lowering treasury rates. Buying bonds is the same as lending, so thus you are lending to the US government at a low interest. The US government gets to deficit spend on war, entitlements, and infrastructure. Deficit spending leads to higher overall US government debt loads. US can maintain this as they have guaranteed buyers of their debt. Government either spends this money directly or sends it via transfer PMTs to Americans. Government agencies and consumers buy raw materials, consumer staples, manufactured goods, and agricultural products. Again, this goes over here and connects to the end result, which is Liberia gets hyperinflation, US gets consumer goods and valuable commodities. And it goes to here as well. Since these goods come from developing countries, this money flows back to exporting countries with trade surpluses, and it all starts to recycle and continue on. So bull here continues. This is part of the milkshake, and the process of recycling is part of the reason why US equity and bond markets have done so well in the last 3 or 4 decades. The constant inflow of capital creates a steady bid for assets in the US. The outperformance of the US markets is massive. If you had invested $1 into the S&P in the 1980, it would have been approximately $98.68 by the end of 2023. The same $1 invested in the world index, including the US, would only be worth around 19.63 over the same period. Huge, massive outperformance by the US market in that time frame. Again, the key differentiator here, especially in currency terms, is that the US is the only currency with external demand for its currency. No other fiat has this. To summarize the dollar milkshake theory, according to Santiago AU Fund, the global financial system can be imagined as one giant milkshake made up of liquidity, debt, and capital. The United States holds the largest straw, allowing it to drink capital from the rest of the world. So it's an extractive process. By being the world's reserve currency, by having the world demand their dollars, the US can export all that debt. It can use the currency, it can print the currency and buy all these external goods, and it will have a place for people. It will have demand for its debt constantly and be able to extract as much as possible. It's the largest straw drinking the milkshake of currency. While many countries are engaged in similar monetary policies, such as low interest rates and quantitative easing, the US enjoys a unique position since it issues the world reserve currency and it has some of the most liquid and trusted financial markets. Sure, the US might have a myriad of fiscal problems, but so does everyone else. This makes the US the cleanest dirty shirt in the laundry, as Brett Johnson puts it. This behavior creates a flow of capital into the US, which in turn strengthens the dollar. When the dollar rises, it puts pressure on other currencies, especially emerging markets that have borrowed in US dollars, because they now have to pay back their debts in a currency that has become more expensive. This dynamic can create a feedback loop where financial stress abroad leads to a stronger dollar, which then causes even more stress for dollar borrowers outside the US. If foreigners sell their US treasury bills to intervene in their currency market, Japan, cough, cough, this worsens things. The FX intervention doom loop, selling UST to intervene in USD spot market, USD yields rise relative to foreign FX, and USD strengthens. So it creates this crazy doom loop. This is another video here by Brent Johnson. I'll post this whole thread in the description as well, talking about the dollar milkshake theory and explaining it as well. And we continue here. DXY rising, therefore, is a symptom of systemic liquidity issues, not a sign that investors are necessarily more confident in America. Chinese buying of USD or Argentinian purchases of dollar assets is more about those investors trying to escape their own failing currency and less about the actual fundamentals of the American economy. Again, this is the milkshake, the one straw. All the other currencies are getting weakened as the dollar strengthens because of the problems outside of the US. While this may benefit the United States in the short term by attracting capital and keeping its market strong, Brent also concedes that the situation is not sustainable forever. At some point, the system could break under the strain of too strong dollar and pressures it places on global economies. Anyways, what's going on with the Dixie? Well, in the last 3 months, we've seen a continuation of dollar weakening that is due to the market's reaction to the trade war that Trump kicked off on Liberation Day back in April. Less trade means less short-term demand for dollars. So again, that's why Dixie has fallen. The relatively cheap dollar will actually enforce the milkshake. I know that sounds paradoxical, but it's true. Dollar-denominated debt is often created outside the United States, what's known as the Euro-dollar system, a vast network of offshore dollar banking activity that isn't regulated by the Federal Reserve. So it's US dollar-denominated deposits at foreign banks or foreign branches of American banks. In this system, foreign banks extend US dollar loans to non-US borrowers such as mining companies in Chile, oil producers in Nigeria, or car manufacturers in South Korea. Again, please refer to the Eurodollar Substack piece for more depth. These companies may be operating entirely within their own countries and generating revenue in their local currency, but the loans they take are priced and must be repaid in US dollars, creating demand for US dollars. Once these companies take on dollar debt, they're locked into a financial structure where their liabilities are in dollars, but their income is usually not. A copper mine in Peru might sell copper in the market and get paid in soles or another non-dollar currency. To meet the dollar debt obligations, which could include interest payments or full loan repayments, they have to convert their local currency revenue into dollars. This typically involves going into the foreign exchange markets to swap their local currency for USD. If the dollar rises relative to their home currency, the cost of that swap increases, making it more expensive and more painful to service their debt. The company is now not just managing its business, it's also speculating on currency exchange rates without intending to. Therefore, when the Dixie is lower, meaning the US dollar is relatively weaker compared to other major currencies, it becomes easier for foreign companies to service the dollar denominated debts. Not only can they more easily pay off existing dollar liabilities, but they may also feel confident enough to take on even more dollar debt to fund growth, expansion, or speculation. This is where the feedback loop begins. As more companies around the world borrow in dollars during periods of dollar weakness, the overall size of the dollar debt system expands. This doesn't only relate to companies, and entire sovereigns see this effect as well. When the dollar is cheaper, it also becomes easier for foreign nation states to accumulate US dollar reserves, a crucial part of their financial defense mechanism. See Japan's interventions. Since their own currencies are stronger relative to the dollar in an environment with a lower Dixie, they can exchange fewer units of their local currency to buy more dollars. This makes building up a foreign reserves far less costly. While dollar bears point to the rising US debt or de-dollarization efforts as a sign of the dollar's decline, the reality is that the global hunger for dollar liquidity is still very much alive, and in many ways it's growing, not shrinking. Paradoxically, all this means is that the end game, for lack of a better word, will not play out how the dollars think it will. A global monetary collapse will mean that the dollar's index races higher, not lower, and if Dixie falls, as Brent says, this just means that the game will continue as re-dollarization begins. The dollar having the status as a reserve asset and reserve currency are two separate functions, and although they are interlinked, in theory, the greenback could lose the former without losing the latter. The milkshake, at least in the medium term, means it won't lose reserve currency status easily, and like a coiled spring, the lower Dixie goes, the higher it will eventually pop, putting strain on the global monetary system. Whoa, okay, so this is much more complex than I think a lot of people realize, and I think that there's this, it almost feels like there's this self-repairing mechanism with the Dixie. So with as the dollar goes down in value, it becomes more attractive to the rest of the world that isn't dollarized to denominate or to have dollar denominated debt of some kind, or to or to hold dollar denominated debt even. So it encourages more buyers constantly into this system, and then that strengthens the dollar. And when that happens, it becomes more difficult. So there's just this kind of cycling feedback loop with the US having so much extractive capability because they have the dollar as the reserve currency for the world in this way. What this makes me think of in relation to Bitcoin is that the financial entrenchment of the dollar system they're very entrenched. It's very structurally, it has this self-repairing ability, like I mentioned with the globe. There's still this huge demand, and as the dollar goes down in value, there ends up being more demand, right? So I think that it's going to take a while. Bitcoin is still this small niche thing. It's going to take a while before before enough people recognize that it is a better system, that we can not participate in these dollar denominated debt games where there is so much extraction going on by the issuer of the currency and of the debt. And we can step away from that. We can step into this other monetary system, which is Bitcoin, and we can store our value in that. So I think that is ultimately, again, all roads lead back to Bitcoin, but this is important to know and important to recognize that maybe a lot of the bolstering of the deficit problem and all of this is maybe more of just a narrative and not actually true, because the US has benefited greatly from the deficits, from the trade deficits, and there has been a problem of eroding the middle class, but does the government really have the middle class in its sights for who it's trying to protect? That's to be seen, that's to be determined, and I think maybe in some way they do. So maybe they'll try to do a couple things, but you can see how entrenched the rest of the world is in this financial system. And as more and more people wake up, maybe we can move away from this. That's my hope. And hopefully this was interesting to you. I learned a lot from reading this. I really enjoyed this perspective, this theory. This is incredibly interesting. And I'll post the link to it in the description. And of course, if you guys have any questions about Bitcoin, if you need any help with your Bitcoin, you can reach out to me directly and book a one-on-one. And if you want to buy some Bitcoin, you can use Bitcoin Well. They're a non-custodial exchange. If you use my link in the description, you'll get some free Bitcoin on sign up. They have non-KYC options available and the lowest spreads in Canada and the US for a non-custodial exchange. You can also preserve your seed phrase for generations to come with the Stampseed Titanium Seed Plate Kit and get 15% off using my code BTC15. Thanks everyone for watching, and we'll see you on the next episode of Bitcoin Not Crypto.